President Donald Trump recently announced that he has postponed the implementation of a 25% tariff on most goods imported from Mexico for 1 month. This decision comes after discussions with President Claudia Sheinbaum of Mexico and is part of ongoing trade negotiations related to the U.S. Mexico-Canada Agreement, USMCA. Tariffs are essentially taxes that governments impose on imported goods, making them more expensive in the domestic market. The idea behind tariffs is often to protect domestic industries by encouraging consumers to buy locally produced products instead. However, they can also lead to increased prices for consumers and strained relations with trading partners. This development is particularly relevant given the current state of global trade dynamics. Tariffs can have significant effects not just on import prices, but also on consumer confidence and broader economic conditions. Trump's previous tariff threats have already contributed to volatility in financial markets, leading to concerns among businesses about potential hiring freezes and investment delays. According to reports from Christopher Rugaber of the Associated Press, Trump's announcement aligns with statements made by Commerce Secretary Howard Lutnick, who indicated that reciprocal tariffs would still be enforced as planned starting April 2. Lutnick's comments suggested that while there may be temporary relief for Mexican goods compliant with USMCA guidelines, uncertainty still looms over other imports. Additionally, Canadian Prime Minister Justin Trudeau expressed his apprehension about the ongoing state of trade relations between Canada and the United States. He noted that despite this month-long reprieve for Mexico, Canada could remain embroiled in a trade conflict due to existing tariffs imposed earlier this week. Looking at historical context, Trump's approach echoes previous instances where administrations used tariffs as a negotiation tactic, often leading to tit-for-tat responses from affected countries. For instance, during his first term in office, Trump leveraged tariffs against various nations including China as part of his broader strategy aimed at rebalancing trade deficits. In terms of impact, experts warn that while temporary suspensions might provide short-term relief for certain sectors like automotive manufacturing, a move prompted by feedback from companies facing steep costs, long-term consequences could include higher consumer prices and inflationary pressures, as stated by economists concerned about rising costs stemming from such policies. Furthermore, historical parallels exist where similar strategies led to long-lasting rifts between trading partners. Previous trade wars have resulted in economic disruptions, not only domestically, but also globally, leading some analysts like Edward Alden from the Council on Foreign Relations to describe it as a shift towards using trade policy as an instrument of economic warfare rather than mutual benefit. In conclusion, Trump's recent decision to delay tariffs may seem like a step toward easing tensions temporarily between the U.S. and Mexico, and potentially avoiding immediate price increases. The bigger picture reveals underlying complexities associated with tariff policies. Moves could ignite further retaliatory actions or contribute to long-term economic challenges if not approached delicately within an increasingly interconnected global economy. We continue monitoring these developments. It's crucial for viewers and stakeholders alike to remain informed about how these changes will shape both local markets and international relations moving forward.